Good afternoon, everyone. I'm Ram Kumar, welcoming you all to this webinar on India as pharmacy of the world, with a special focus on our HDFC Pharma and Healthcare Fund. With me is Nikhil Mathur, who is the fund manager running the strategy. We also have Sandeep Singhi, our investment specialist, who will be helping me to moderate this call. Let me set some context as we proceed with this call as to why India's healthcare story stands out as one of the most compelling long-term investment opportunities. Firstly, on the global fund front, India has firmly established itself as a major pharmaceutical powerhouse, holding significant market share in various regions, global regions like US, Europe, and various emerging markets, whether it's complex generics, biosimilars, specialty formulations, or even R&D capabilities. Indian companies have built a reputation for quality, affordability, and scale. That is on the global side. On the domestic side as well, our healthcare market is undergoing a major transformation, mainly backed by rising incomes, increased insurance penetration, the rising need for advanced medicines. So we are also witnessing a strong expansion in other areas like hospitals, diagnostics, and other healthcare businesses. So this theme is backed by a dual engine, global scale versus domestic demand, that creates a powerful, diversified theme for long-term investors. One unique thing about the pharma and healthcare space, especially from an investment point of view, is that it offers diversification at three levels. How I mean, first, the revenue stream diversification. We saw that both from global companies as well as from the domestic markets, the revenue is generated by these businesses. Secondly, this segment also offers not just large pharma companies but also other type of businesses like hospitals, diagnostics, and various other businesses. And third, and most importantly, the listed space from the pharma and healthcare theme is kind of diversified from a market cap perspective. Large cap leaders like Sun Pharma or a Divi's or a Cipla. Mid cap space also has companies like Lupin, Glenmark, Alchem, and many other names. Small cap opportunity is also big in this space. So in fact, our portfolio, if you see, is a mix of I think kind of a one third, one third, one third kind of a mix of large, mid, and small cap names. So the fund is designed to capture the entire spectrum of this opportunity. Last but not the least, the fund is now more than 2 years since it launched. There is a strong alpha of nearly 5% since its inception. Even in the last 1 year, the fund has done extremely well. So with that, it's my pleasure to invite Nikhil, who will take you through the current outlook on the sector and also the fund's philosophy and positioning.
Yep. So thank you so much for attending this webinar. So I'll take 15 to max 20 minutes in running you through a few slides. The slides are basically structured on three fronts. One is to give you a flavor of how the entire landscape looks like. Second is some of the recent developments, recent trends that are pretty relevant for this particular fund. And third, I'll take up valuations and positioning of the fund across different caps and different subsegments. So without wasting much time, so I'll just start with the first section of the fund. Yep. So as Ram mentioned in his opening remarks, the fund name is Pharma and Healthcare. It seems that it's a pretty unidirectional or pretty focused theme. But if you look at the kind of companies that are available to invest in this particular scheme, they are pretty diverse. So we capture three major opportunities via this fund. One is the domestic healthcare spend. So in India, there is an increasing penetration of insurance and quality healthcare. There's an aging population, but at the same time, life expectancy is increasing. So there's a big spend happening in the Indian market, which is offering opportunities. On the export sides, we have been leaders in generics for a while now, but we also see the Indian companies making big inroads in the CDMO space. So we'll talk about that how exports going forward, we are capturing that opportunity in this particular fund. And to top it off, I think the country has built a manufacturing leadership over the last 25-30 years, boosted by certain government initiatives like PLI, labor cost advantage, and an R&D ecosystem which is boosting the competitiveness of Indian companies. So the investable universe is broadly divided into pharma and healthcare services. Within pharmaceuticals, we have three major subsegments. There is domestic formulations, there is exports, primarily in US generics and now in biosimilars as well. And the third big opportunity on the export side is the CDMO, contract development and manufacturing. On the healthcare services side, we have diagnostics, hospitals, and certain emerging spaces like retail pharmacy and medtech, which is also proving to be a growth driver for this particular space. Let's revisit some recent developments and some trends which are likely to govern the broader healthcare landscape in the coming 5-10 years. Starting off with some recent regulatory developments. So there have been three developments of late which we feel are kind of positive for the positioning that we have in the fund. I'm sure it's very topical and it perhaps is the elephant in the room, what's happening on the tariff front. And to our positive surprise, I think the US government for now has taken a pretty rational stand. They exempted the patent protected drugs from exemptions from tariffs for now. And on the generics also there is an exemption, though obviously there's a caveat here. The policy of the US government at this point seems pretty mercurial. There can be some flip-flops here and there. But I think by and large, we are not overly worried about tariff situation impacting negatively whether the generic company or the CDMO companies, and hence we are pretty positive that no adverse developments have happened on the tariff front, especially in the last 2-3 months. Second is, you might have heard about the Biosecure Act. So there was a version of this act which was passed last year, but then the government changed and it went kind of on the wayside. Now again, there is a new act or a modified Biosecure Act by the name of National Defense Authorization, which has come into the picture now. Now, this again prohibits certain biotech companies from participating in the US R&D ecosystem. And given that there are no Indian companies named, there are certain Chinese companies named in this particular act. So we feel that there will be a positive tailwind for the Indian companies when global companies will try to outsource more from outside of China, which is where I think India has a ready ecosystem. And on the domestic side, you might have heard about a central government health scheme, the pricing for which was long due revision. So almost rates of 2,000 medical procedures have been revised positively after 10-15 years. Now this bodes well for Indian hospitals, perhaps to a certain level for diagnostics as well. And this is where I think there have been a positive regulatory development on the domestic side as well. So we are talking about three positive developments which has happened for the space in a span of 2-3 months. Now coming to the more structural trends, moving beyond the most recent developments, what are we seeing that can help this entire space? GLP-1 drugs have become a rage. I don't think this category of drugs needs any introduction now, but I'll just revisit quickly what has happened here. Now these are a type of drugs which initially were approved in US and Europe for type 2 diabetes. But then these drugs have also given a lot of comfort to global regulators that there can be weight loss associated with these drugs. The resultant impact is that in a span of just 7-8 years, the GLP-1 global market size has gone up to almost $90 billion. Now, how can Indian companies capture this opportunity? I mean, it's a bit nuanced, but let me just give some color here. So these drugs are likely to go off patent in a host of countries from next year, key markets being China, India. You can see in this table I have laid out what can be the addressable opportunity in a 5-year time frame from now. We are talking about $6.7 billion of opportunity in 6 major markets where these drugs are going off patent starting next year. So that's a big opportunity, and the proof of concept is that Eli Lilly's Mounjaro, which was launched in India just 6-7 months back, it is already clocking 1,000 crores of revenue in the Indian market. So the demand potential is pretty significant for these sort of drugs, and many Indian companies are positioned directly or indirectly to kind of capture this opportunity. Beyond GLP-1, I think the trends are pretty structural in nature. For the last 10-12 years, we are now seeing that the Indian households, which is kind of captured by the government's private financial consumption expenditure data, we are seeing that an average a household is spending much more on healthcare than the overall spend that they have in a particular household. And despite this trend continuing for the last 10-11 years, what we see is that India's healthcare spend relative to GDP still lags materially countries which are part of the BRICS group. I mean, we talk about Brazil, Russia, China, South Africa. I mean, India is more comparable to these economies than the developed markets. We see that India's spend to GDP has hovered around 3.3% in the last 10-12 years, whereas most of the other countries of similar economics strata, they are much ahead at 4, 6, even 9% as well. So I think there's a long runway for growth available given the penetration is still pretty nascent in the country. The biggest undercurrent or the biggest change that's happening from the healthcare spend perspective is the increase of insurance penetration. If you look at the group and individual insurance coverage, it is now standing at almost 31 crore people. This number has grown to 2.6x of levels which were seen in FY18. So as you can see that there is a big penetration uptake happening on the insurance side, which is directly benefiting the overall healthcare ecosystem in terms of growth. And I think there is still runway left for this penetration to increase. If I compare the insurance penetration as a percentage of population, it has now reached 40% levels, though it has increased quite sharply in the last 10 years. But I think this number can continue to go up in the coming decade as well. So I think what we are seeing is a big tailwind of insurance penetration, affordability, rising per capita, which is kind of directly benefiting the domestic healthcare ecosystem in terms of growth. Some trends, let's say in domestic pharma, there has been a slowdown in volumes over the last 10-12 years. There are a number of factors governing this. There is a better penetration of acute medications. There is some bit of shift happening towards generics or the unbranded medicines as they're called. But we are not overly worried by this trend, because what we also see at the same point is that many of the large companies, let's say the top 20 companies, are kind of growing faster than the market. And most of the listed companies operate in the top 20 cohort. So we are not overly worried about the volume slowdown that the broader market is seeing in the last 10-12 years. Formalization is a big structural lever. There was a latent demand for quality healthcare in the country, boosted by affordability and rising per capita and insurance. So what we see is that most of the organized players, even in diagnostics, areas like diagnostics and retail pharmacy, they are growing faster than the broader market growth. And there is still quite a bit of room available for this penetration to go up. For instance, in diagnostics, we have still 73% of the market taken by the unorganized players. As this market moves from unorganized to organized diagnostic chains, you'll see better than market growth. If I look at the retail penetration of pharma, if I look at other countries, we are nowhere close to even calling it a proper penetration of organized share. So I think formalization across multiple segments, sub-segments is what is driving quite a bit of growth for this space. Moving on to the export side, I think CDMO has been the buzzword for the last 1.5 years. And there are reasons, and this has been for the right reasons, I believe. If I look at the global macro landscape here, there is a global pharma R&D spending which continues to grow. Now, if I project the next 10 years, we have taken data from some public sources here. The global R&D spend is likely to compound by 6% in the coming 10 years. Now, this is a direct growth lever for CDMO companies, whether in India, Europe, China, or South Korea. But at the same time, India's share of global CDMO is kind of minuscule. Various estimates peg the Indian CDMO market to be more than $150 billion, and within that, India's share is roughly $3.5 billion. So you can imagine the kind of runway available that Indian companies have in terms of growth in CRDMO, and we are seeing that this is no longer an hypothesis. If you look at some of the portfolio companies in our fund, or you track numbers of various CDMO companies, the growth for the last 3-4 years has been pretty good. I mean, in some cases even north of 18-20% as well. So I think geopolitical diversification, availability of talent pool in the country, and last 20-25 years, the track record of US FDA compliance that Indian companies have built, I think all of these factors are kind of contributing to a healthy growth environment that companies in this particular subsegment are witnessing. And also on the macro front, there is a environment on the biotech funding which is much better than what it was 2-3 years back. There's a direct correlation between interest rates and biotech funding environment. In calendar year 22 and a part of calendar year 23, there was a major dip in quarterly funding of biotech companies. But what we see in the last 4-5 quarters is that this number has picked up, and we are seeing a YOY growth in certain quarters now that is starting to emerge. Sorry. So I think this is another macro tailwind that over the next 2-3 years can play out for companies operating in the CRDMO space. On the US generic side, I think there should be some bit of caution at this point in our view. Certain leading indicators like drug shortages, they are trending down, and historically what we have seen is that when drug shortages, they move up, there's a better pricing cycle, and when drug shortages, they go down, the pricing cycle turns adverse. So we are a bit cautious on this space, but we won't be structurally negative on this space anymore, because the pricing environment has been benign for the last almost 10 years now, more than that. And structurally, the number of product approvals in the US and number of product filings in the US have come off. So given this construct, I don't think we should be overly negative on this particular space. But given where the valuations are, we are slightly cautious on this particular space, and at a better point in time, we will kind of favorably revisit our stance on this segment in particular. So I think these were the broad trends. I'll come to valuations. I think it's a pretty important topic to kind of touch upon. So we divide. I usually discuss my framework on valuations on two fronts. One is how the pharma valuations are and how the overall healthcare valuations are. Now, pharma companies are a subset of the healthcare index that I'll talk about in the subsequent segment. Nifty Pharma is a more relevant index for just capturing the pharma companies here. Now what we see is that there has been some cool off in pharma valuations. At the start of the year, if someone would have come across my comments on the positioning of the fund and the broader index, I think we were not very optimistic about the broader index. We still are not overly optimistic about the broader index, but the index is starting to correct a bit now. So index from the peak of 32-33x 1 year forward earnings multiple is now down to 29-30 times, and the premium to its last 10-year average is 20%. It had kind of shot up to one standard deviation. I think that's a positive development for the fund for the next 2-3 years. On the healthcare services side as well, the premium tends to be much higher because you have hospitals and diagnostics in this particular space, which trade at a much higher premium. We are seeing some cooling off on the broader healthcare side as well, though it's still not very attractive enough to call out that the index itself will bottom out. So the point of highlighting the index here is that both Nifty Pharma and BSE Healthcare, they are better off now than what we started out at the start of the year, but it's still not overly comfortable in terms of the historical averages. But having said this, I think we are less worried about valuations going forward now, because as we have been highlighting in our communication over the last 2.5 years, it's a very broad space. We have at least 90-100 companies to choose from to build a portfolio. So even if the index doesn't perform well for good 1-2 years, we still are able to figure out opportunities which can deliver positive returns and in turn alpha over index and over peers over a reasonable time frame. So as Ram mentioned, I think if you look at the market cap composition of HDFC Pharma and Healthcare Fund, we have pretty high representation of small caps, large caps, and mid caps are also there. So we take a sort of bottoms up call on companies on their earnings cycle, and we don't mind going very aggressive on having no weight on some large index names as well, which is why you will see that our performance has been pretty decent since the fund has been launched. So the fund is aggressive, taking in account the earnings growth of on a bottoms up basis for various companies, and that's how I think we want to continue to run this particular fund.
Mutual fund investments are subject to market risks. Read all scheme related documents carefully.